Good morning. It's Jeff Christian of CPM Group. It's 11:45 here in New York on Friday, the 17th of May. I want to talk about precious metals markets. The prices have risen sharply. The title here is Assets Rise on Investor Interest Hopes, Not Expectations. I'm referring to an old Little Rascals episode where two of the boys are in a restaurant, a diner, and the guy behind the counter says, "What do you boys want?" And they start saying, "Well, I want a pork chop and a hamburger and a malted milkshake and a piece of pie." And the short order cook says, "Well, how are you expecting to pay for this?" And the one kid, Spanky, says, "I'm not expecting it. You asked me what I wanted." I think that what you have with a lot of financial markets right now is a lot of hopes that interest rates will decline. And we've talked about this ad nauseum over the last several weeks, and we'll talk about it again today. That's probably the last thing you want to hope for, and I'll show you why in a second. It's not necessarily their expectations in the market that interest rates are going to fall soon, but it's their hope. And I think that hope is a little bit misplaced. Now, gold is over $2,400 as I speak, about $2,402. It has risen back to that level. Silver shot all the way up to $31. It's a little bit below $31 right now. Platinum and palladium are also up sharply over the last few days. And I want to talk about why that is. And I'll talk about the implications for these markets in a second. But one of the key points to remember is that it's not just gold and silver and platinum and palladium. Stock prices have risen. They're off a little bit today, but they have been at record levels in the United States. The bond markets, corporate bonds and municipal bonds, their prices have also risen as interest rates have fallen about 45 basis points for 10-year corporate bonds over the last 4 weeks. Copper has risen. Copper has a special situation. There is congestion in the COMEX market. There are also some supply disruptions in the copper concentrate market, which probably is the source or the origin of the congestion in the COMEX copper market. So copper is something of a special thing. But you have stocks, bonds, copper, precious metals, other commodities, all rising. And a lot of it is expectations of lower interest rates. And the markets have, and market views toward interest rates have been very volatile, flipping back and forth as the economic data presents a mixed picture. And we've talked about this. This is the kind of mixed picture you expect late in an economic expansion. PPI came out on Tuesday of this week, and it showed some decline, a small decline in producer prices. The big sticking point were services and transportation services in particular in the PPI. In the consumer price index, which came out the next day, you saw another modest decline. Prices are still high on a year-over-year basis, about 3.4% for headline inflation and about 3.6% for core inflation, excluding energy and food. Again, the biggest sticking points were services, transportation services and health services, I believe, were the two biggest factors in terms of keeping inflation rates higher. And those things are sticky, and they're causing problems. On a month-to-month basis, U.S. consumer prices were 0.3%, again, off a little bit from February and March, but still high and higher than the Federal Reserve and other people would like to see. So inflation continues to be a mixed bag. You also saw industrial production figures come out Thursday, and they were showing signs of continued weakness in industrial production across all sectors of the U.S. economy. So you're seeing signs of an economic slowdown. which is what we've been expecting for some time. It's not imminent, but it's clearly on the horizon. This is the Fed funds rate, and you can see that it tends to rise late in the economic expansion. Other people will flip it around and say, Fed funds rate, interest rates that the Federal Reserve manage, rise at just before recessions, and they cause the recessions. That causation is fallacious, and it speaks to not really understanding. There is a correlation between rising interest rates and recessions, but it's not that the rising interest rates cause the recession. Interest rates are rising because in the late stages of an economic expansion, there are inflationary pressures. Wages tend to be higher, the costs of goods tend to be higher, service costs tend to be higher. You tend to see a lot of constraints on continued economic growth in the late stages of an economic expansion after you've been going on for 5 years or 10 years, which is more common these days since 1983. Prior to 1983, recessions occurred roughly every 5 or 6 years, sometimes even more close. In the period from 1907 to 1913, before the Fed was created, and really one of the reasons why the Fed was created, you had numerous recessions in that 5-year, 6-year period. 60 months out of the 90 months, we were in a recession in the United States between 1907 and 1913. After the Fed was created and after the Great Depression, you saw maybe 5 or 6 years between recessions, and that lasted up until about 1980, 82. We had that double dip recession, one in 1980 and then one in 81, 82. And since that time, we've seen fewer, less frequent, shorter, shallower recessions, with the exception of 2007, 2009. But you see the interest rate rising late in the economic expansion. It's not that the interest rates caused the recession. It's a bouillabaisse of real economic activity, wages rising, costs rising, demand for goods and services running into production constraints and supply constraints. So a variety of factors that cause an economy to tip over into a recession. And we're kind of seeing some of the indications that that's there. So what's all that mean for gold and silver? Started off with the gold prices. Gold prices have been rising since 2000, really. They got to a record in 2011, came off, were kind of weak from 2013, middle of 2013 until the middle of 2019. They have been rising strongly. You can see here on the left-hand side is the price of gold, the COMEX gold first nearby futures since January. Kind of flat January, February, rose sharply in March, rose even more sharply in April. It's consolidating around those record highs into the first half of May. CPM Group's expectation is that the price will continue to rise because we will see continued constraints in the real economic economy. We will see continued problems on fiscal policy. Those things will hamstring monetary authorities and cause the monetary authorities to continue to be relatively conservative with their monetary policy. They will try to keep the economy from tipping over into a recession, but monetary policy can only do so much in terms of stanching the bleeding. It's really fiscal policy and real economic factors that matter. Yeah, and there you've got real problems. Those problems are probably going to be worse in the second half of this year than they were in the first half of this year, into 2025. And we expect to see that worsening economic environment coupled with a worsening political environment cause investors to buy more gold and keep the gold price high and rising. So we are expecting higher prices in the second half of this year into 2025 than what we've seen in the first half. And insofar as the prices have gotten to where we thought they might be in April and May, and they've gotten to levels that we thought we might not see until September or October, it just tells us not that the peak is here, but rather that the peak will be higher than we had thought. Not saying that it's going to $10,000, but we will see higher prices. And again, be very mindful of the difference between intraday peaks, which last up to 20 minutes, and annual average prices, which is what matters to mining companies and investors really on a long-term basis. Silver prices have run a similar pattern. They're showing greater strength now in April and in May. That's a little bit of catch-up. It's a little bit of market hype. And it's a little bit of investors saying, okay, silver should perform more like gold and less like an industrial commodity, which is what you're really seeing going on. We do expect silver prices to rise further over the next 6 months into 2025. But, to some extent, they have maybe made half or a third or 2/3 of their upward move already just in the last 2-3 months. Platinum and palladium prices, they're also showing some strength right now, but they continue to be relatively weak. Palladium, obviously, much more weaker than gold. Platinum, I think there's about a $70 or $80 spread that's opened up with platinum at a premium to palladium again for the first time in many years. You can see here down the left-hand side how platinum prices fell in 2012, 13, 14, and then really have traded sideways, broadly between $1,000 and $1,200 for most of the last, really $12,800 and $1,000 for much of the last decade, and with a couple spikes up to $1,200 and $1,300. Palladium did much better in the period from 2017 through 2021, into 22, but since that time has come off sharply for a variety of factors. So we do think that the prices of platinum and palladium will probably move sideways to somewhat higher as gold and silver move higher. Next week, we will not have a Tuesday video. We have other commitments elsewhere, so we simply won't be around to make that video. We will be launching our Silver Yearbook, and we'll have an online free briefing at 10 a.m. on Thursday, the 23rd of May, that you can sign up to participate in. You can send questions ahead of time. And then we will post that silver briefing. It's live on Thursday. We'll post it on YouTube on Friday. So in lieu of a 12-minute, 15-minute video next Friday, they'll have like an hour and a half or a 2-hour silver seminar. Gold yearbook's already released. Platinum yearbook's coming out in the middle of July. You can go to our website, cpmgroup.com. You can get free reads. You can order books, $160 for the silver yearbook, $160 for platinum or gold yearbooks. There are more expensive reports that are available. There's a lot of free reads and videos at our website. And you can send an email to info@cpmgroup.com if you have questions or issues that you want to raise, if you're interested in finding ways to become a client. That's all I have for now. Take care of yourself. Have a good weekend. Be good to yourself and to those around you, and try to make the world a more peaceful place and a better place. Take care.